Welcome to the deep dive. You know, in the world of big tech, it's usually loud, fast-paced. Some companies are always grabbing headlines, right? Dramatic stock moves, buzzy new gadgets. But what about the quiet one? The one not always shouting from the rooftops? Today we're diving deep into Alphabet Inc. That's GOOGL, of course. Through a lot of 2024, early 2025, the perception has often been, well, flat. Maybe even a bit boring on the stock front.
Yeah, and if you've been watching the tech space, you've probably noticed that. Wondering why a giant like Google seems kind of stuck in neutral while others are, soaring. Yeah. You're definitely not alone in thinking that. As of, June 2025, the stock's up maybe 4%, 6% year to date, which, let's be clear, trails the NASDAQ, the S&P 500. And it really trails peers like Nvidia or Microsoft. So, yeah, a lot of investors are feeling, let's just say it, frustrated.
Totally understandable frustration. So that's our mission here today. We want to explore this counter-narrative. What if this performance isn't stagnation? What if it's more like a spring coiling up, getting ready? We're going to dig into the evidence, see if the market might actually be, seriously underpricing Alphabet's quiet strength. By the end of this, you should have a much better handle on the story behind the numbers, the potential in Alphabet's different bets that maybe people misunderstand, and why this company might be sort of quietly gaining real weight, even if Wall Street isn't making a big deal about it yet.
Okay, let's start by unpacking that map perception a bit more. Like you said, that 4-6% gain by June 2025, it's positive, sure, but it's not exactly setting the world on fire. It's lagging the indices. And very noticeably, companies like Nvidia just riding that massive AI hype wave, right? Mm-hmm. And then there's Microsoft, which, seems like they just can't miss right now.
It's a really stark contrast, isn't it? And it fuels that investor feeling of, being underwhelmed. A lot of folks, retail investors, even some fund managers, they kind of expected Alphabet to be a bigger part of the AI boom story, more dramatically. It sometimes feels like Wall Street has the attention span of, a toddler hopped up on sugar. Seriously, if an earnings call doesn't mention transformational AI disruption like 5 times, the stock just gets left in the dust.
And what's interesting is how different Alphabet's approach is. They tend to be more measured in their tone. You've got the split leadership structure. Mm-hmm. And they seem genuinely reluctant to, overhype things before they're fully baked. They're just not playing that same loud game, which in this market can definitely read as boring.
Right, and it makes you think of that old Benjamin Graham line, doesn't it? The market's a voting machine short-term, but a weighing machine long-term. Right now, the votes seem to be going to the louder, flashier names. But the sources we looked at suggest Alphabet's fundamentals are quietly putting on serious weight, even if the votes aren't there quite yet.
Exactly. And if you look past that short-term market mood, look at the cold, hard numbers. The recent earnings report was, frankly, pretty staggering. Revenue, $83.9 billion. That's up 11% year over year. Solid growth. Operating income, $25.5 billion.
And the cash flow, $17.3 billion in free cash flow. They're sitting on, over $120 billion in cash and equivalents. And this is key, basically no significant long-term debt. So you've got this flat-looking stock, but the company itself is just a money-printing monster. What does that contradiction even mean?
It just highlights this huge disconnect, right? The core business search ads, mostly it's still an absolute juggernaut. It funds everything else. Plus, YouTube keeps growing, keeps being profitable. Android is still dominant in mobile. And Google Cloud, after all that investment, it's finally turned profitable. This isn't some struggling company. It's generating massive amounts of wealth.
It really makes you wonder, when you kind of mentally strip out the, let's call it, over-exuberance from some other AI stocks, why does Alphabet look, as our sources put it, downright cheap? Its forward PE is under 23. Compare that to Microsoft at 32 or Nvidia. Nvidia's in the stratosphere, over 50. The numbers seem to tell a very different valuation story than the market's currently telling.
Which brings us to that big question, that media narrative you hear all the time. Isn't Google behind on AI? That story's been sticky. But when you really dig into it, scrutinize it, just doesn't seem to hold up.
It's a super common take, though, isn't it? Yeah, okay, OpenAI and Microsoft, they grabbed the early headlines for sure, and Gemini's initial launch, maybe a bit of a PR fumble, fair enough, but writing Alphabet off in AI, it feels short-sighted, like betting against Amazon and e-commerce because Shopify had one good quarter. What specific things challenge that behind on AI narrative?
Well, it really comes down to their fundamental strengths, their long game. Take Google DeepMind. It's not just a leader. It's arguably the global leader in foundational AI research. And not just language models, which get all the press, but biology, robotics, multimodal AI. AI that understands text, images, sound, video all together. That's way deeper than most people realize.
And didn't Gemini 1.5, even with its quieter launch early in 2025, didn't it actually beat GPT-4 on several benchmarks? Plus, they've got Gemini 2.0 supposedly on deck for Q3. And don't forget their hardware advantage, those TPUs, the tensor processing units, their own custom chips for AI. That must help massively with costs and margins, right?
Hugely. It's a significant in-house advantage. And then there's Google Cloud's AI services. They're sort of quietly becoming the engine for a lot of enterprise AI, especially in data-heavy fields, think healthcare, logistics. So for really complex jobs like, I don't know, analyzing medical data or optimizing massive supply chains, Google's AI is increasingly the choice. They're embedding themselves deep in critical industries. And you mentioned YouTube, that YouTube plus AI combo. That's really underrated. It's already boosting engagement, AI video summaries, better recommendations, new tools for creators.
So, okay, Wall Street wants the splashy story, the loud narrative. But Alphabet seems to be delivering, what did our sources call it, boring execution. And one source basically said that's a huge market mistake until it isn't.
Right. Okay, so moving beyond the core business, let's talk moonshots.
Yeah.
These ventures that are still early, maybe the market dismisses them, but they hold massive long-term potential. Waymo, for example, self-driving unit. This isn't just some R&D lab toy anymore. It's a real product, real riders, real cities.
That's such a critical point people miss. We're talking fully driverless robotaxis, publicly available in Phoenix, expanded operations, no safety drivers in SF and LA, pilot tests running in Austin, Miami. And the rider feedback is apparently really strong, like over 90% satisfaction. Meanwhile, some competitors keep promising robotaxis next year. Since, 2019, Waymo has just been quietly racking up millions of miles. So how big a deal is it that the market isn't really pricing this in?
It's huge potential that's being ignored. The market hasn't priced Waymo in because, it doesn't make significant revenue yet. Keyword yet.
Yeah.
But look, if Waymo is even moderately successful, our sources suggest it could unlock a multi-billion-dollar business, transportation as a service. Think about how that could change car ownership, urban mobility. That's pure optionality, basically free upside in the current stock price.
Okay, let's switch gears to Google Cloud. For years, the story was, oh, they're the distant third, right? Behind AWS and Azure, they also ran. But that narrative has completely flipped now, hasn't it?
It really has. Google Cloud finally hit profitability in 2024. That was a major turning point after pouring money in for years. And now, it's actually growing faster than both AWS and Azure percentage-wise year over year. Its specific advantages are really starting to click with big companies.
What advantages specifically? What's making businesses choose Google Cloud now?
Well, a big one is the tight AI and cloud integration. Native support for Gemini, Vertex AI, which Vertex AI lets companies build and deploy their own custom AI models easily. Plus, the DeepMind APIs. That's a powerful draw. Then there's security. Their whole zero-trust architecture is considered leading edge, crucial for regulated industries. And BigQuery is still dominant for data analytics. So yeah, as companies scale up their AI projects, Google is becoming a preferred partner, not just the third option. This revenue stream is now a serious contributor to Alphabet's value, and our sources think it's only just getting started compounding.
And then, YouTube. The giant hiding in plain sight. It's so many things at once, isn't it? World's second biggest search engine, social network, TV network, TikTok's biggest rival, and apparently, quietly, one of the most profitable parts of the whole Alphabet empire.
Absolutely. Generated, over $45 billion in revenue last year? Mostly ads, yeah. But beyond ads, you've got YouTube Premium subscriptions growing nicely, YouTube TV keeps expanding, and YouTube Shorts has become a really serious player in short-form video, gained a lot of traction. Plus, they're pushing AI tools for creators, which juices up engagement and how fast new content gets made.
Okay, so if YouTube alone did over $45 billion in revenue, what does that imply about its value if you could somehow, isolate it? It feels like the market just kind of glosses over how massive it is because it's tucked inside Alphabet.
That's exactly the point our sources make. If you spun YouTube out tomorrow as its own company, it would probably command a valuation north of $300 billion.
Yeah.
Easy. Think about it. That's roughly on par with Netflix. But YouTube has a way bigger user base, more diverse content, more ways to make money. It really highlights a huge, maybe underappreciated asset sitting right there inside GOGL.
Okay, let's talk leadership for a second. That's another factor sometimes cited for Alphabet's lagging stock, Sundar Pichai. Since he took over both Google and Alphabet, you hear some investors grumble, too cautious, too conservative, even, too boring. What's the counter argument there?
Well, the counter from our sources is pretty clear.
Yeah.
That boring style. That might be exactly what you want steering a ship this massive, $1 trillion ship.
Yeah.
I mean, while some other tech CEOs are maybe tweeting themselves into trouble or trying to fight people. Pichai just quietly builds. He doesn't seem to overpromise, doesn't overspend wildly, and crucially, he rarely misses earnings. He delivers consistently.
It feels like maybe Wall Street rewards the cowboys in the short term, but actual long-term compounding, that wealth creation, that's often built on exactly that kind of steady, boring execution, not just vibes or hype.
That's the argument. Consistency is what Pichai delivers.
Okay, another past criticism. Alphabet just hoarded cash, didn't return enough to shareholders. But that seems to be changing too, right? They've done, what, over $70 billion in buybacks just in the last couple of years?
Huge buybacks, yeah. And the big symbolic move. They finally started paying a dividend in early 2025. A modest one, but still. Plus, there seems to be more discipline around those moonshots we talked about. Clearer timelines now, stricter targets for return on investment.
So if Alphabet keeps heading down this path, acting more like, say, Apple with capital returns, steady buybacks, growing dividends, smart reinvestment, what could that do for how the market values the stock, for its multiple?
Our sources definitely suggest that kind of shift could lead to a pretty significant expansion of its valuation multiple. It signals maturity, discipline, shareholder focus, things the market tends to reward over time.
Right. Now, we absolutely have to address the elephant in the room, regulatory risk. It's just constant background noise for Alphabet, isn't it? Antitrust cases, US, EU fines, privacy lawsuits, these are real.
Oh, absolutely real risks, no question. However, the general consensus from the sources we reviewed is that these risks are probably largely already priced in. The market knows about them. Alphabet has taken steps, diversifying ad revenue slightly, trying to improve transparency, and the really drastic outcomes like a forced breakup or having to fundamentally change core products, those still seem pretty unlikely, according to most analysts. Plus, you got to remember the timeline here. Regulators move slow, courts even slower.
Yeah.
And while all that plays out, Alphabet keeps innovating, and it keeps making tons of money.
So putting all these pieces together, the financials, the AI reality, the moonshots, the leadership shift, the regulatory context, our sources seem to be building a pretty strong case for a potential re-rating of Alphabet's stock. Soon, maybe, once this intense AI hype cools down a bit for the really hot names. Where does that institutional money go next, do you think?
Well, the thinking is it rotates into what our sources call underappreciated quality. And Alphabet kind of fits that bill perfectly, doesn't it? Scale, profitability, growth, but maybe overlooked potential. It seems like the poster child for that kind of rotation.
Okay, so what could be the actual trigger, the catalyst for a breakout?
Could be any number of things, really. Imagine Gemini 2.0 comes out and clearly beats GPT-5 in real-world performance. That'd be huge. Or Waymo expands to another major city, like New York maybe. Or even just hits profitability in one market. What if YouTube's growth suddenly reaccelerates? Or Google Cloud lands some massive government contract or a big healthcare deal. Even just credible rumors of spinning out YouTube or Waymo could light a fire, or simply stronger guidance on dividends and buybacks. Any one of those, or a combination, could potentially make Alphabet the surprise breakout story of late 2025, maybe into 2026.
Okay, so let's wrap this deep dive up. The core message seems to be, Alphabet isn't broken. Far from it. Our sources suggest it just seems boring, but maybe only if you're not paying close enough attention. The stock might have looked flat, yeah, but the underlying business, the fundamentals, quietly getting stronger and stronger. It's diversified, it's showing more discipline, and it's just, as one source put it, dripping with optionality. AI, Waymo, YouTube, so many different levers they can pull. And crucially, they have the cash, the resources to pull them at scale.
Yeah, the market's been distracted, chasing the louder stories. Understandable, maybe. But money, eventually, tends to find its way back to where the real value is being created. And Alphabet, viewed through this lens, really does seem like it's hiding in plain sight, coiled up, like that spring analogy, just waiting for its next big move.
So you can call its recent run flat if you want, but our deep dive today suggests maybe don't blink. Because it probably won't stay that way for long. Maybe something to think about. Could boring execution actually be the ultimate edge in the long run, especially in a market obsessed with short-term hype?